Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and impact. I'm Govindraj, Ethiraj. Reserve Bank Governor Raghuram Rajan has kept the policy rate on hold at 6.75% in last week's monetary policy review. Now, it is widely believed that the Reserve Bank will wait until after the government's budget statement at the end of February before taking a call on cutting rates further. The Reserve Bank had cut repo rate by 125 basis points in 2015. Now, while not everyone was expecting a cut at this point, the question remains, why was there no rate cut at this point? Second, what are the implications of not cutting rates to consumers and businesses and for an economy that is not growing as fast as everyone expects? And finally, why are banks still holding back and not transmitting the rate cuts that the Reserve Bank has initiated earlier to you and me? To discuss this, I am joined by Soumya, Kanti, Ghosh, Chief Economist at State Bank of India, and Sujan, Hajra, Chief Economist at Anand, Rathi Securities. Thank you both for joining us. Soumya, so let me begin with you. So why did the Reserve Bank not cut rates?
See, I think it was widely expected that the RBI will not cut rates.
Why is that?
Because the first thing is that the budget is around the corner. And if you look at the statement throughout the policy, the RBI has indicated that it wants to look out for the budget. So that's the first thing. The second thing is that RBI wants to read through some of the inflation numbers in the next couple of months before taking a final call on whether to go for another dose of rate cuts or so. But my sense is that the budget being round the corner, the Reserve Bank did not want to take any chance and just now waiting for the government to take the cue from the budget and see how the fiscal consolidation path is laid out, whether the government wants to go for a budget deficit which is higher than 3.5%.
Right. And the Reserve Bank has already hinted that they don't like an expansionary fiscal policy.
They don't want the government to deviate from the path. Also the numbers in the budget. And I think last year also after the budget was announced, the Reserve Bank went in for a rate cut, even though if you remember, the fiscal deficit numbers were higher than what the market was expecting at 3.9%.
So let's understand both the points that you mentioned. The first is you said that the Reserve Bank would like to read inflation rates a little more. What does that mean?
Means I think there has been some traction in the CPI numbers in the last month. So I think the base effect has now materialized, and also the fact that if you look into the RBI fan chart, it is now saying that the January numbers with the RBI fan chart is typically showing is around 5.3%. So which is significantly lower than 6% the RBI is projecting. So that is one thing that the RBI wants to watch out for, because when the next policy comes, the January numbers will also be in their domain. And also the fact that how the government is basically playing on the fiscal consolidation path. But I think it has more to do with the deficit, fiscal deficit numbers, rather than to do with the inflation.
So explain to us quickly and for our viewers very quickly. I mean, so when we say that the government is likely to be fiscal expansionary, which means it's likely to spend more than it earns. So how does that affect interest rates?
See, basically the idea is that if the government borrowing program is larger and the fact is that the market has not appetite for such larger numbers. For example, if you just look into the very simple terms, if you look into the supply of government papers and the demand for government papers, if there is not such demand for government papers in the market and the supply is significantly to the higher side, that always pushes the interest rate higher. Because one way is that the argument is that it basically could crowd out the private borrowers from the market. So therefore, if there is a limited resources available in the market, so interest rate will go up. So therefore, the RBI wants the government to stays on the fiscal consolidation path. So this is then thinking of RBI. So it is in their interest, they can actually, that can open up the space for monetary accommodation.
Got it. So then implications of not cutting rates at this point of time, and because there is a section of the economy which is still wanting rates to be cut, they include both businesses and individuals.
See, if you go back to the early 2015, if anybody would have told you that RBI will cut the rate by 125 bips, you would have asked what the person is smoking, because nobody expected 125 bips. So RBI has done a lot in terms of rate cut, but as you have seen, this hasn't got transmitted either in the debt market or in the credit market during the whole year. So obviously the transmission is the main issue which is in RBI's mind right now, because the point is that even if RBI goes and cutting rate, and obviously the short-term rates are largely following, the interbank rates are largely following the RBI's policy rate, but it's not getting transmitted on the longer end. And if you are talking about a revival in demand, if you are talking about distressing the corporate sector, it's really the long-term interest rate which needs to go down. But that's not exactly what's happening. So from that perspective, RBI will try to transmit this effect. Obviously, if there is a space to cut rate from the current level, RBI will take that opportunity also. But the main focus now is
so you're saying that in any case RBI has delivered so far, so hold on, wait for a little longer. So let's come to the next question. So why are banks still not transmitting rates?
No, I think that I just want to have a different perspective over here. Let me just give a very simple example. If you look at the deposit structure of banks, 60% of these are interest rate changes to interest rate and 40% are interest rate agnostic. I am talking about the CASA. So now the RBI has cut rate by 125 basis points. So basically 60% are interest rate agnostic, means if you multiply 125 basis point by 60, it comes to around 70 to 73 basis points. Now if you look into the RBI monetary policy statement, the median rate cut of all the banks is around 64 basis point. And for example, for State Bank, we have cut by 70 basis point. So that means if you look at that portion of the interest rate, which can changes to interest rate, because current account doesn't.
So you're saying if I have taken a loan from you, I have been benefited positively,
exactly.
At least, yeah.
So basically in that case, the transmission I think has happened almost on the full side, because at the end of the day, there are a lot of issues about transmission, but if you look at only the part which is impacted by the interest rate, excluding the CASA out, the 60%, and the 60%, if you take the 60% into account, I can say that the base rate should actually go down by around 70 basis points or odd, which in fact it has moved down.
But to a consumer, it may not feel like that, right? I mean, I'm paying 10-11% interest rate, but the bank rate is still 6.75.
No, basically, see,
I'm just saying, just to explain it.
No, I agree with you too. I think for a layman, it may not be easier, but let me tell you another thing over here. In Indian context, the banks actually, out of the bank's borrowings, 97% are basically from deposits, and only 1% is from the RBI window. So basically, 1% of the, so if a bank borrows 100 rupees, and whatever the bank borrows, that actually ultimately goes out for lending purposes. So basically, if the bank is borrowing only rupees 1% of the NDTL is the basically RBI window, then 97% of the aggregate deposits. So as long as the deposit rates don't go down, it cannot transmit to the cost of funds. And if you look at the deposit rates basically are the problem in India is the deposit rates, once if you are locked into the deposit rate, that it is only getting transmitted after 1 year, because if you start cutting, you cannot cut interest rate for the new deposits. So therefore now the banks have cut the deposit rates. So therefore the lending rates have started to move down, and I am sure that over a point of time with the RBI also moving on to that marginal cost lending fund, lending rates will move down.
So the other reason why rates are not coming down is obviously the quality of assets and the quality of stressed assets in banks. Sujan, what's your take? I mean, how well are we unwinding that today?
No, first and foremost, I am slightly differ with the argument of why rates are not going down. If you look at the spread, the point which you are telling, the cost of fund of the banks and the rate at which they are lending, it's one of the highest in the world. So banks really cannot argue that their cost of fund, because the spread history is one of the highest, and this is one point Governor Rajan has many times told. But that brings us back to the point which you are raising, why this spread is high. Because the credit cost is high. If you look at the public sector banks in particular, about 13% of their assets are stressed, either restructured or they are already NPA. Obviously, that's the bigger problem, and that's basically makes banks. If you look at actually the performance in terms of recovery performance of the public sector banks and private sector banks, there is absolutely no difference between public sector banks are as efficient in terms of credit monitoring and recovery and credit appraisal. So the real problem here for the public sector banks is that they are at the head office level, the management of the NPA is not good, and that's what basically is adding to their cost of credit, and that's why they cannot reduce the spread, and that's why the interest rates effectively are not coming down.
Right. So Soumya, what's the unwinding is what I'm trying to understand, because now the Reserve Bank is also nudging banks to, there's the last quarter where it wants to have a complete and clean picture of everything that's stressed, so that we all as shareholders, as depositors, as maybe citizens get a sense of what really the health of the banking system is.
No, see, I think you cannot deny that the health of the banking system is currently not that good. But I think if we just digress and look to the period of 97-98, at that point the health of the banking system was even worse. The gross NPA was at 16%, but which came down to less than 5% by 2006. It was a 9-year period. But that was also the time when there there was top line growth on the part of the banks because global growth was also there, and also there was significant amortization of debt. If I remember, the rates were actually cut by 500 basis points.
And it was also a big period of post-liberalization economic activity.
In my sense, I think that at the end of the day, I mean, as long as the, even though even though the banks clean up the balance sheets, which has been actually a continuous basis,
correct.
I think as long as the demand doesn't pick up, it is not going to impact. So even if my sense is that at the end of the day, you need to move on to a lower interest rate regime so as to stimulate growth. Otherwise, this has been the situation in the past, and as of today, I still believe that if you actually look into the 10-year yields, the 10-year yield, if you they are the same level what as they were when they actually the repo rate was at I think 8% under. So 10-year yields have not moved down. Then you have to look at the money market rates, they are actually now moved up. So if you look into the entire totality of the term structure of interest rate, this is in fact moving up. So in my sense, as long as that also doesn't happen, it will always become difficult for the banks to transmit.
Right. Okay. So let's look forward now. We've got the union budget coming up. Now, obviously, things will only improve if there's a combination of monetary and fiscal stimulus. So what are we looking out for? So then let me begin with you.
First and foremost,
policy,
we are talking about the budget, of course. In the budget,
because we've seen monetary policy or whatever, and then now let's see the.
So our sense is that maintaining this 3.5% fiscal deficit number is going to be extremely difficult for the government, not because of anything else, but because you are going through a deflationary phase. So your real GDP growth is really low, and for the first time last quarter we saw the nominal GDP growth lower than real GDP. But having said that, in terms of monetary amount, absolute monetary amount, my sense is that government will be able to meet the target both for the current year and the.
And what would be your prescription?
Obviously, government has to maintain fiscal prudence. Beyond that, if you see in terms of priorities, the first priority is of course to deal with the rural distress. Second priority is to kickstart investment, particularly in the infrastructure sector. So I think these are going to be the two overbearing priority. Beyond that, creation of job through skill development, through Make in India program, and employment creation through that. These are the kind of things which I think will be the priority of the budget.
Got it. Okay, Soumya, your outlook and prescription.
No, I think for the budget, the first thing is that the agricultural sector needs to be relooked into. I think some increased focus on areas related to rural development, irrigation. That is one thing. The second thing is that the government needs to spell out how is going to support the banks in terms of the recapitalization, because the fiscal space is completely stretched. So that the government needs to speak out how is going to help the banks. In this context, I think some sort of announcements like some sort of a bad bank could be very well and timely, because India is going through the pace, and if you need to clean up the balance sheet also, that will take some amount of time, which may leave constantly space available for lending. So I think some available tools for the banking space, some space for the agricultural sector, and some sort of incentives for financial savings, because I think the section 80cc, the PPF numbers have gone up, the PPF savings have gone up. That will also be very useful for our infrastructural activities.
Okay, so when you say financial savings, what could that mean? Would it mean more tax benefits, or?
Yeah, some sort of tax benefits. For example, section 80cc could be widened. That could be one of them. The spending on the medical insurance could actually also go up. So because we have seen that after the PPF limit was raised, there has been a lot of traction on the PPF deposits. So that could be one way of channelizing the Indian investment savings, because yesterday the NIF was launched, and I think if that is the case, the National Infrastructure Investment Fund. So in that case, I think the government also needs to see that the domestic savings is going up. They have already gone up to 32.3% as per the latest data, and that trend needs to continue if India has to finance it huge infrastructural activities,
including from domestic investments, for which banks will play a critical role, for which banks have to be in good health.
Exactly.
And interest rates should be also sort of favorable for that. We've run out of time, gentlemen. Thank you so much. We'll be back after a break. On the other side, we'll look at some of the expectations on the budget from the infrastructure sector. Stay with us. Welcome back to Policy Watch. India's economy may not be growing as fast as many of us would like it to, but it is surely growing faster than its infrastructure can keep pace. Road Transport and Shipping Minister Nitin Gadkari said on Rajya Sabha TV show Spotlight last week that India needs $1 trillion of investment for new roads, ports and airports in coming years. Now, the challenge lies in both finding the resources and deploying them effectively. Minister Gadkari said he did not see a shortfall in funds. He said he was asking for an additional 15 to 20,000 crore over the 45,000 crore in the union budget. Now, with Budget 2016 around the corner, addressing the funding gap is one challenge, but more importantly, what more can the budget do to ensure that projects get off the ground faster than before and completed in a sound time frame if India has to add another 2% to its GDP in coming years? Joining me to discuss this are Chintan Lakhani, Associate Director Infrastructure Ratings from India Ratings and Research, and G. Chokkalingam, Founder Economics Research and Advisory. Gentlemen, thank you very much for joining me. Chintan, let me begin with you. Let's pick roads and let's pick roads first. So, what is the broad demand gap that you see first? And number two, what we're trying to understand is what are the kind of policy imperatives that we can look at in the budget that could potentially fix some of the gaps that we are looking at?
Sure. There have been a lot of positives initiatives which have been undertaken, something like 100% equity divestment, annuity awards for compensatory annuities in case of delay in terms of from the NHAI, and some of the lag. If I say, I think there has been an expected increase of allocation for the highway sector to about 85,000 odd crores, up double from what was about 42,000 crores last year, and in the previous budget to about 27,000 odd crores. So we see a lot of positive action in terms of initiatives and measures, announcements and policy initiatives, but still on the ground actions like delay in terms of ROW clearances, land acquisition issues, dispute resolutions, they need to be buckled up. So I think we need some action from the budget on those measures as well.
Okay, but is that sort of typically budget territory?
Yes, they are, because in the sense that if there are certain allocations, increased public spending also, continued increased spending also, if we see, they'll provide some impetus to the stalled projects also, because day in and day out we talk about projects, infrastructure projects being stuck. So there will need some public spending, continued public spending, which will of course lead to private investments also coming in. So there has to be some window of hope for these investments to come in to help these stalled projects as well.
Right. So what's changed in the last 1 year then? If you were to take a little step back, and let's not talk about roads only, but let's expand the ambit a little bit to include ports, power, etc.
Right. From the airports, ports wise, there have been a lot of regulatory clearances, regulatory clarities in terms of the hybrid model coming in for the airports. From the ports, yes, there have been an impetus to the credit enhanced structures which have been provided to the renewable bond markets as well. We see a lot of incentives on a lot of activity from a private players also. And in terms of, if I talk about National Infrastructure Investment Fund as well, the NIF, which is called the Fund of Funds, where it was announced in the previous budget, it is expected to be rolled out in the current one, and talking about 20,000 odd crores from the government for about 49% stake, which is expected to be leveraged for other equity, further equity infusions.
Right. So if you were to take a sort of more simple explanation for this, all this means is that the ability to raise funds is going to be easier, and therefore the funds deployed will be much more than ever before.
That is what the developers and the market general investors are also expecting. Yes.
Right. Okay. Chokka, let's look at the capital side, right? So Nitin Gadkari talked about $1 trillion of investment could potentially go into roads, ports and airports in coming years, and that in turn will take India's GDP up 2%. If all of this really happens in the time frame that we wanted to. How is the markets looking like today to feed the kind of capital that we want?
Certainly market is not ready. That can be a great ambition, but the point is that you have four sources of capital supply. You have banks, they are struggling to grow 11% the credit base, and you have government. It is focusing on the fiscal consolidation, so the scope is limited. Third, you have FDI. That's the only segment where you have robust inflows. In December, it has grown by 114% year on year. But if you see the net FDI inflow and then compare with the net capital outflow on account of gold, it's almost evens out.
Okay.
The fourth area, that's the only area which used to be vibrant, is the stock market. And it has got its own problem. Now the banking sector has got a dominant weight in the whole index. And that is a sector which is sinking. So, of course, the government cannot buy shares and provide support. LIC has been doing, but it's getting exhausted. The only way to lift the stock market is, help the banking industry. This is not the time to give a lot of, pressure for restructure assets or extra tax provisions. And you are, on the other hand, you have to help them in the sense, postpone all these measures. Let them get up particularly the PSU banks.
So when you say postpone measures, you mean?
The stringent norms for the restructured assets.
Okay.
Because
but isn't that sort of logical in some way that unless you restructure, then you will not?
It is absolutely logical, and the intentions are good, but the timing is bad.
Okay.
Because the kind of gross NPA, net NPA the PSU banks have, even the ICICI bank, sequentially gross NPA is up by 33%, which is I have not seen in the last 20 years. So the times are very difficult. It's a crisis situation because of the global deflationary pressures and some governance issue with some borrowers. So PSU banks are in a very, very crisis mode now. So this is the time, instead of having a stringent norms from the monetary authority, be more flexible at least for 1 or 2 quarters, allow them to strengthen the balance sheet, don't force them to even pass on the interest rate cut to the borrowers. It's like a government, the cut in the oil price, it is strengthening the balance sheet, not by not passing on to the people. Similar analogy I can draw. So allow them to take the benefit of the interest rate cut. So strengthen the balance sheet, and then you will see, both the lending will also improve, and also, in the stock market, the prices will improve. And therefore, you can avoid, the forced selling of promoter shares pledged in the market.
Okay.
Otherwise, if the market keeps going down, there is a possibility of crisis.
Right. Okay. I'll come back to the market in a bit and your outlook for that. So, Chintan, what's your sense on the resources that we require, whether it's the $1 trillion figure that Nitin Gadkari spoke of, or in general, the ambitious figures that are being spoken of?
See, of course, what we see in our day-to-day interactions with our issues as well is that yes, the investments have dried up. There is kind of a negative sentiment from a private parties as well. That's why I highlighted the earlier point where there needs to be an increased continued public spending also, which of course hopefully should kind of increase private spending as well. We also read about projects not being bid out as well. Bid out for as well. So that is again kind of a slack in the investor sentiments as well. And some of the earlier measures of the budgets, like the plug and play model for the power sector, the road regulator also, which was announced in the budget about 2 budgets back. We need to see some actions on those grounds as well. Single window clearances also has been talked about in some of the other earlier budgets as well. On the ground action, like I said, clearances and as well, we need to see some transparency, some clear action on that as well.
Do we need more of these little things, or do we take a step back and say, okay, here's one composite, simple, new policy that will drive some of these things forward?
I think it could be a mix of both, because there are certain steps initially which we need to take to kind of take stock of what hasn't been addressed earlier. Like I said, the plug and play model or the roads regulator as well. But yes, at the same time, you need one single step, something like a single window clearance, which helps to at least redress the grievances currently facing the situation, ROW clearances, and we come across projects where there are different clearances or different approvals required from different intergovernmental departments also. So if they are kind of clubbed under one window, one authority, that will kind of make matters a little easier. Then, like I said, single window road regulator, something that we highlighted, or there could be some other body, autonomous body, which kind of takes or is given the responsibility to kind of take the responsibility for all the approvals, clearances for passing of all the infrastructure projects or road projects. So it could be for road projects, one power sector, it could be one accordingly.
So let's talk about power. We've mentioned that. So what's your sense there? I mean, we've seen a lot of announcements. We've seen an effort to make the whole debt situation for state electricity boards come down. Do you see all this adding up?
Frankly, from a counterparty discount perspective, yes, not much is kind of improving. From the private side, one silver lining in the dark cloud would be that there are foreign private players which are taking investments or which are taking stakes in the current projects across thermal, renewables as well. So that is one encouraging thing that we see in the power sector as well.
Okay, but in power, I mean, you've written a report saying that we have a funny problem. We have actually, despite demand being what it is, one is of course demand is not going up, but the other is that we are seeing the lowest plant load factors in decades, which means plants are not generating as much power as they even could, despite coal being available.
We've seen that, and more so in renewables also. There are certain stabilization issues and teething issues as well, where the plant load factors are certainly affected. So yes, like you rightly said, we are seeing record lows of PLF being recorded, and that is one side. And on the offtake side, of course, the discom problems of the discom utilities also continues. Yes.
Right. Okay, Chokka. So let's we've got this problem on one side. On the other hand, you were mentioning to me earlier that stocks of many infrastructure companies, L&T being a classic example, they're all falling. So why is that happening? Is it because of the general headwinds that we are facing from markets maybe outside India as well, or is it something to do with their perception domestically?
It is both global deflationary pressures. This is the first time across the board. Even the agri crop prices are 6-year low. So the entire global deflation pressures are impacting, because that has impacted the oil price, and many companies have infrastructure projects in the Gulf, so that got impacted. So that is the reason for L&T also. On the domestic front also, the industrial economy, if you look at the core sector cumulative growth, it is less than 1%. So you have both, and that is impacting the overall aggregate demand as well as the capital. So completely dried up. So therefore, the government has to do both. Infuse the energy for aggregate demand to shift vertically, and also provide a lot of capital to the banks, and through some compromise on the fiscal consolidation. According to me, that's the only way to provide.
Right. So and that aggregate demand to some extent will also be pushed by infrastructure spend, which is what we've all been betting on, including in areas like railways. So what's the composite sort of ask looking like, Chintan?
We would say at least again increased investment from the railways perspective also. I think the allocation is one part, the actual spending is another.
And that's where we've seen a gap.
Exactly, we've seen that gap. So even though, like I said earlier, the allocation might increase to say double is what at least the Highway Ministry have asked for, the actual spend is something that we would want to see. And that in turn will kind of initiate a cycle where even the private investment would kind of improve, and that hopefully should see a turnaround. Of course, we are not expecting any immediate turnaround in the fortunes of the sector because of the backlash that it's been seeing. But at least this will at least provide some momentum to the entire investment cycle and for the better fortunes of the sector as well.
Right. And what's the, this is a very sort of broad question, but if these investments keep going, at least if we look at a 1-year budget frame, budget to budget, what is your sense of the turnaround? Where could we start seeing downstream impact?
We could see some impact at least a year or so from now, because like I said, most of these sectors, if you talk of thermal, renewables, road sector, they have seen some of the other issues, PLF factors, plant load factors we mentioned, traffic issues we always have been speaking about in our highway sector reports as well. So if these initiatives kind of go through, we could gradually definitely see a turnaround, say about 12 to 18 months.
So increased investment, hopefully more single window clearances, or at least consolidated window clearances. Chokka, what are you expecting from the budget, particularly in regard to banks, infrastructure?
I firmly believe that there ultimately, final hour, there will be a compromise on fiscal consolidation, a move away towards spending more money for the banks and infrastructure. That's what I definitely expect. Otherwise, my fear is that we were headed for some sort of crisis.
Okay, and if assuming things don't become as bad as you think they would be, what's the sort of positive side?
Positive side, I still remain optimistic. I am fully invested. I still no short position. Fully optimistic. Because as you said in the beginning, India is still the fastest growing economy. The global pain has got a gain for India. Even in the next fiscal, we are going to save at least 2 lakh crore from the oil. And the government is doing a right thing by not passing on the benefit to the public and retaining it and strengthening the government balance sheet. So therefore, in FY17, there are a lot more resources, to infuse into the system.
Right. So we've got a strong base that's building up. Hopefully that will fuel everything that we've been talking about. Thank you so much for joining me. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.